In this lecture we are going to go over a step-by-step process on how to identify manipulative maneuvers in the market. Keep in mind that these instructions are only low-resolution guidelines that should make your life easier if you are starting to learn the market maker's strategy. What I mean by that is that every step that I am going to outline must be unpacked into a high-resolution analysis, and many of the steps are subjective. However, a low-resolution guideline can have some utility. I am also going to assume that you have a firm grasp of the tridimensional axis of market manipulation, the ideas of liquidity pools, market depth, order clusters, the various types of lines you can draw under this methodology, and the recognition of the price signatures left by large traders. If you don't understand these concepts well, I suggest that you go back to the previous lectures and review them or send me an email to clarify your doubts. The very first step is to decide the amount of price information you will have available on the chart. If you have too much past information, you will be dealing with irrelevant events, and you will not be able to zoom in price action to see the individual candlesticks' nuances that are so important. On the other hand, if you don't use enough price information, your analysis will lack the necessary threshold for a good contextual story for your trade. One good rule here is that you should not have less than 100 candles on your chart and you should not have more than 200 candles as well. That seems to be a good starting point. There are exceptions to this rule, but for most cases this should give you a good idea of how much past information you should look at. Let me remind you also that this rule remains constant independently of the timeframe you trade. The second step is to make sure that you maintain yourself in the timeframe that you have chosen previously without shifting back and forth to check for new information. That seems like a good idea at first, but it has disastrous consequences. The motivation for these two first steps is to limit the scope of your analysis, which is something that increases your focus. If you don't define these things carefully, you will not even start your analysis correctly most of the time. The third step is to mark and count the highs and lows on your chart. This is really important because without a clear view of the highs and lows in the chart, you will not be able to see manipulations properly since it's all about the relationship between price extremes. I suggested that you number the highs and lows so you can make quick references when you write on the chart. This is something that helps maintaining things neatly organized. The fourth step is to imagine what the retail traders might be thinking in the current market scenario. Observe that you will attempt to think like a retail trader for a specific reason. You will not be acting like a retail trader for reasons that should be obvious to you at this point. That means looking for the highs or lows that retail traders might be considering a good place to put buy or sell orders. This is a relatively straightforward thing to do. Once you have completed step number 4, you can move on to step number 5, which is where the fun really begins. In this step you will be looking for the price signatures that will give you a subjective sense that market makers are indeed trying to motivate retail traders to buy or sell a specific high or low. These price signatures are of course the things you would find under the von Restorff effect. You have to pay attention to subtle things like market makers trying to press price, the sudden increases in volatility and things of that nature. Paying attention to the candlestick's tails is also very helpful since they often shed some light about the buying and selling pressures of the levels where they occur. This is an incredibly important step, and it's also a subjective one. That's what I mean by a low-resolution guideline in the beginning. Step number 6 is to observe how price behaves once it breaks the high or low that you identified as a possible axis for the manipulation. In this step you should be looking for candle nuances like the way candle tails behave in relationship to the high or low that was broken. Here is where you must be able to identify the end of the von Restorff effect and the beginning of the reverse psychology and bandwagon effects taking place. Step number 7 is to observe how price reacts after the alleged manipulation. You should be able to pinpoint signs that indicate the market is going in the opposite direction of what the retail traders previously thought. Here you will be once again looking for nuances like shifts in volatility and the creation of new highs and lows. It's important that you are capable of telling a logically consistent story of how the manipulation took place. Step number 8 is to draw the various types of lines you learned in previous lectures, so you can try to identify possible levels where a trade opportunity might arise. This is where you have to be creative and use other tools like support and resistance lines, and even other methodologies like the fractal flow for example. The more elements you have pointing to the same area in the chart, the better and stronger the signal is going to be. Step number 9 is where you will be combining the line work with the contextual story about the manipulation to form a trade idea. These are the two fundamental elements that must be present in your analysis. You cannot look for just technical setups to trade a methodology like this because it's based on market logic and trading psychology more than anything. That's why looking for good lines only will lead to failure. It might work once in a while, but it will fail eventually. Step number 10 is choosing the entry, stop loss and target for your trade. The stop loss in this methodology always revolves around the candle that spiked the high or low that was allegedly manipulated. That's almost always the case. The target can be a combination of line work of various sorts, but if you want to keep things simple, you should make it between 3 and 4 times as large as the stop loss. It's also better if this predefined target correlates more or less with a previous market level that has some degree of significance, like a previous major high or low. Triggering the trade is a little bit trickier because many traders require an absolute black and white signal to do that. The first thing I would suggest for beginners and intermediate level traders is to wait candles to close before pulling the trigger. You can enter the trade after an inside candle or an outside candle, for example. A fractal candle is also a very good idea. The idea is that you identify a momentary stop in price, then you can employ a variety of methods to enter. Step 11 is to let the trade run its course. There is a good reason we plan things so well in advance, which is to avoid real-time improvisation in decisions that involve risk. If you decide to change your trade after it's opened, you will make decisions that are more biased than what they should be, and this is something that always ends in disaster. It's important that you maintain a solid trading ethic, unlike the retail traders who are very sloppy about their operational rules. These 11 guidelines should be enough to put you on the correct track, roughly speaking, but as I said in the beginning, they are a low-resolution representation of what you should be doing. If that was not the case, we would not need the other lectures in this course to fully understand the market maker mentality. You still have to study all the details of the methodology as hard as you can, to the point where you internalize them, and they become second nature to you.